Right now, nearly 5 million homeowners in America could lower their monthly payments by refinancing their mortgage. 5 million. And most of them don't even know it. The ICE Mortgage Technology February 2026 report showed that when rates dipped to just 6.04% in January, the number of people who could benefit from refinancing jumped by 20% overnight. That is not a small number. That is a wave of opportunity crashing right at your doorstep. And here's the thing that hurts. Most people will let that wave pass them by. They'll keep paying more than they need to, month after month, year after year, thousands of dollars, just gone. Because nobody sat them down and explained how refinancing actually works. Nobody gave them the steps. Nobody showed them the math. Well, today, that changes. This is your full course on how to refinance a home. We're going to break down every single step, from understanding what refinancing really means, to knowing exactly when to pull the trigger, to getting the best deal possible. And later in this video, I'm going to show you a simple calculation that tells you whether refinancing will save you money or cost you money. So stay with me. Let's get straight to it. What is refinancing? It's simple. Refinancing means you replace your current home loan with a brand new one. That's it. You're not buying a new house. You're not moving anywhere. You're just swapping one loan for a better one. Think of it like this. Imagine you signed up for a phone plan 3 years ago, paying $150 a month, but today, that same plan costs only $90. Wouldn't you want to switch to the cheaper plan? That's refinancing. The Mortgage Bankers Association reported that refinance activity hit a 17-week high in January 2026, with refinances making up 62% of all mortgage applications. That means more people are refinancing right now than buying new homes. Why? Because the math makes sense for them. They're trading an expensive loan for a cheaper one. Now, when you refinance, your new lender pays off your old loan completely. Then you start making payments on the new loan instead. The goal is usually one of three things: a lower interest rate, a lower monthly payment, or pulling cash out of your home's value. And we're going to cover all three in this course. But first, you need to understand why interest rates matter so much. And that is coming up next. Here's something most people don't think about. The interest rate on your mortgage is more important than the price of your house. Wait, what? Yes, let me explain. If you borrow $300,000 at 7% interest over 30 years, you'll pay about $419,000 just in interest. But if you borrow that same amount at 6%, you'll pay about $347,000 in interest. That's a difference of $72,000 for just 1%. $72,000! That's a brand new car. That's 2 years of college. That's a life-changing amount of money. And all it takes is moving your rate down by one single percentage point. As of February 2026, the average 30-year fixed refinance rate sits around 6.11%, which is the lowest it has been in over 3 years. So if you bought your home when rates were near 7% or higher, this is your moment. And here's what makes this even more exciting. Freddie Mac's research found that homeowners who refinanced their 30-year fixed-rate mortgage into another 30-year fixed-rate mortgage saved about $2,700 per year in payments. That's $225 every single month going back into your pocket. Now, imagine what you could do with an extra $225 every month. All right, so there are 4 main types of refinancing you need to know about. Number 1. Rate and term refinance. This is the most common type. You simply change your interest rate, your loan length, or both. You're not borrowing any extra money. You're just getting better terms on what you already owe.
Number 2, cash out refinance. This one is powerful. You replace your current loan with a bigger loan and take the difference as cash. So let's say your home is worth $400,000 and you owe $200,000. You could refinance for $260,000, pay off the old loan, and walk away with $60,000 in your hand. Money you could use for things like renovating your kitchen, paying off credit card debt, or covering your kids' tuition. Number 3, cash-in refinance. This is the opposite. You bring money to the table to reduce your loan balance before refinancing. People do this when they need to hit a certain loan-to-value ratio, like getting below 80% so they can drop their private mortgage insurance. And number 4, streamline refinance. This is available if you have a government-backed loan like FHA, VA, or USDA. It requires less paperwork and usually no appraisal. It's the fastest way to refinance if you qualify. Now, which one is right for you? We'll figure that out together. Keep watching. Not everyone should refinance. Let me say that again. Not everyone should refinance. There are specific situations where it makes total sense, and other times when it would actually hurt you financially. So let's figure out which camp you fall into. The general rule most experts follow is this. Refinancing makes sense if you can get a rate that is at least 1 full percentage point lower than your current rate. So if you're sitting at 7.25% right now and you can lock in 6.1%, that's more than a full point drop. That's a green light. But if your current rate is 6.5% and the best you can get is 6.2%, you might want to think twice because the savings may not cover the costs of refinancing. Here are other times refinancing makes sense. Your credit score has gone up significantly since you got your original loan. Your home's value has increased. You want to switch from an adjustable rate mortgage to a fixed rate so your payment stays the same forever. Or you need to pull equity out for a major expense. A report from the CFPB found that cash-out borrowers actually saw improvements in their credit scores after refinancing because many used the money to pay off high-interest debt. More on that later. Now here's the part nobody likes talking about. Refinancing is not free. I repeat, it is not free. There are costs, and you need to know exactly what they are before you sign anything. According to a 2025 report from Lodestar Software Solutions, the average closing costs for a refinance came in at $2,403. But that's just the average. The actual range is typically between 2 and 6% of your total loan amount. So if you're refinancing a $300,000 mortgage, you could be looking at anywhere from $6,000 to $18,000 in closing costs. That includes things like the appraisal fee, which runs between $400 and $1,000, the loan origination fee, which is usually about 1% of your loan, title insurance, credit report fees, and recording fees. But, and this is important, many of these fees are negotiable. You don't have to just accept whatever number they put in front of you. You can call your lender and say, "Hey, I got a quote from another company with lower origination fees. Can you match that?" And more often than you think, they will. The Consumer Financial Protection Bureau says that failing to comparison shop costs the average homebuyer about $300 per year. Over the life of a loan, that's thousands wasted. Don't be that person. Okay, here it is. This is the calculation I promised you earlier. This is the single most important number in your entire refinancing decision. It's called your break-even point, and it tells you exactly how long it will take for your savings to cover your refinancing costs. The math is dead simple. Take your total closing costs, divide them by your monthly savings, and the answer is how many months until you start actually saving money. Let's say you pay $6,000 in closing costs, and your new monthly payment saves you $200 per month. $6,000 divided by 200 equals 30 months. That means after 30 months, about 2.5 years, every dollar you save after that is pure profit in your pocket. A Wells Fargo study noted that most homeowners stay in their home for roughly 12 years on average. So if your break-even point is 30 months and you plan to stay for 12 years, you've got almost 10 years of pure savings ahead of you. That could be tens of thousands of dollars. But if you plan to sell your house in just 2 years and your break-even is at 30 months, then refinancing would actually cost you money.
See how important this number is? Write it down. Calculate it. It is your best friend in this process. Before you even think about calling a lender, you need to know your credit score. This is step 1. Your credit score is like your financial report card, and lenders use it to decide whether to give you a loan and what interest rate to charge you. According to Experian, most lenders require a minimum credit score of 620 for a conventional refinance. For FHA loans, you might qualify with as low as 580. And for jumbo loans, those big expensive ones, you'll typically need 680 or higher. But here's the key. The higher your score, the lower your rate. Someone with a 760 credit score might get a rate a full 0.5% lower than someone with a 660 score. On a $300,000 loan over 30 years, that 0.5% saves you over $30,000. And here's something most people don't know. In November 2025, Fannie Mae officially dropped its minimum 620 credit score requirement for loans processed through its desktop underwriter system. Freddie Mac made a similar change earlier. This means the system now looks at your whole financial picture, not just a single number. So even if your score is a little below 620, you might still qualify if everything else looks strong. But don't gamble on it. Check your score, know your number, and if it needs work, fix it before you apply. I'll show you how, right now. Want to raise your credit score fast before you refinance? Here are the moves that make the biggest difference. First, pay down your credit card balances. Your credit utilization, that's how much of your available credit you're using, should be below 30%. So if you have a credit card with a $10,000 limit, keep your balance under $3,000. Even better, get it under 10%. Second, check your credit report for errors. You would be shocked how common mistakes are on credit reports. Things like a payment marked late that you actually paid on time, or an old debt that should have been removed but wasn't. Dispute those errors with the credit bureau, and your score can jump significantly in just 30 days. Third, do not open any new credit accounts before applying for your refinance. Every new application creates a hard inquiry on your report, and that drops your score by a few points. Fourth, become an authorized user on someone else's credit card, someone with a long history of on-time payments. Their positive history can show up on your report. And fifth, keep your oldest credit cards open even if you don't use them. The length of your credit history matters. Closing an old account shortens your history and can hurt your score. These 5 moves alone can push your score up by 50 to 100 points in just a few months. Do them all. Step 2 in the refinancing process is knowing how much your home is worth. Because your lender needs to know this number to calculate something called your loan-to-value ratio, or LTV. And your LTV determines what kind of deal you can get. Here's how it works. Take what you still owe on your mortgage and divide it by your home's current value. So if you owe $200,000 and your home is worth $400,000, your LTV is 50%. That's great. The lower your LTV, the better your rates will be. Most lenders want to see an LTV of 80% or below for the best rates. If your LTV is above 80%, you might have to pay private mortgage insurance, PMI, which adds to your monthly costs. So how do you find out your home's value? You can start with free online tools like Zillow or Redfin to get an estimate. But the real number comes from a professional appraisal, which your lender will order as part of the refinancing process. According to Fortune's analysis, appraisal fees can reach up to $1,000, though some lenders offer appraisal waiver programs that could save you this entire cost. If your home's value has gone up since you bought it, that's fantastic news for your refinance. It means you have more equity, which gives you more options. And options are power. Let's talk about equity for a moment because it's the engine that drives your refinancing options. Your home equity is simply the difference between what your house is worth and what you still owe on it. If your home is worth $500,000 and you owe $250,000, you have $250,000 in equity. That's your money, locked inside the walls of your house. According to the Federal Reserve, aggregate homeowner equity in the United States was over $25 trillion. $25 trillion. That's an ocean of wealth sitting in American homes. And refinancing is one of the main ways to access that wealth
without selling your house. For a regular rate and term refinance, most lenders want you to have at least 20% equity. According to Fortune, a cash-out refinance also typically requires at least 20% equity. But here's the thing. You don't get to take all of it. The lender will usually let you borrow up to 80% of your home's value, so you always need to keep some equity in the house. Think of equity as your safety net. The more you have, the more choices you have. And later in this video, I'm going to show you how to build equity faster. Don't miss that part. Step 3. Get your paperwork ready. I know, nobody likes paperwork. But if you get this done early, the whole process moves faster and smoother. Here's what you'll need. Your 2 most recent pay stubs. Your W-2 forms from the last 2 years. Your federal tax returns from the last 2 years. Bank statements from the last 2 months. And your current mortgage statement. If you're self-employed, you'll also need your profit and loss statements, your business tax returns, and possibly a letter from your accountant verifying your income. Lenders are more careful with self-employed borrowers, so having extra documentation ready shows them you're serious and organized. Why does getting this done early matter? Because once you find a great rate, you want to lock it in fast. Rates change every single day. The rate you see on Monday might be gone by Friday. If you already have your documents in a folder ready to go, you can submit your application the same day you find a good deal. And that speed can literally save you thousands of dollars. So tonight, after this video, go find those documents and put them in one place. Do it tonight. Not tomorrow, tonight. Step 4, and this is where most people mess up badly. You need to shop multiple lenders. Do not just go to your current lender and accept whatever they offer you. The CFPB found that failing to shop around costs borrowers about $300 per year and many thousands over the life of the loan. That's money you're literally throwing away because you were too lazy to make a few phone calls.
Get quotes from at least 3 different lenders. And I mean 3 different types of lenders. Try your current bank or mortgage company, then try a credit union since they often have lower rates, and then try an online lender like Rocket Mortgage or SoFi. Each lender will give you what's called a loan estimate. This is a standardized document that shows you the interest rate, closing costs, and monthly payment all in one place. It makes comparing offers easy. And here's a secret most people don't know. Within a 45-day window, all of your mortgage inquiries count as just one hard pull on your credit report. So you can shop around as much as you want for 45 days without hurting your score. The credit bureaus expect you to shop for the best deal. They're not going to punish you for it. So use that window. Get 5 quotes. Get 10 quotes. The more you shop, the better deal you'll find. Period. When you receive your loan estimates from different lenders, you need to know what to look at. Don't just compare interest rates. That's a beginner mistake. You need to compare the total cost of each loan. Here are the 3 numbers that matter most. Number 1, the annual percentage rate, or APR. This includes your interest rate plus all the fees rolled into one number. It gives you the true cost of borrowing. 2 loans might both say 6.1% interest, but one might have an APR of 6.3% and the other 6.5%. That means the second loan has higher fees hidden inside it. Always compare APR to APR. Number 2, total closing costs. Look at page 2 of your loan estimate under Closing Cost Details. This shows you every single fee you'll pay. Compare this number across all your offers. And number 3, the monthly payment. This is what you'll actually pay every month. Make sure it includes taxes and insurance, not just principal and interest. Some lenders show you a low monthly payment that doesn't include taxes and insurance to make their offer look better. Don't fall for that trick. Always ask for the full payment amount. These 3 numbers, APR, total closing costs, and monthly payment, are your decision-making tools. Use them wisely. Once you find the offer you want, you need to lock your rate immediately. A rate lock means the lender guarantees you that specific interest rate for a set period of time, usually 30 to 60 days. During that time, even if rates go up, your rate stays the same. Why is this so important? Because rates move every day. Sometimes they move multiple times in a single day. Imagine finding a perfect rate on Monday, deciding to sleep on it, and then waking up Tuesday to discover rates jumped by 0.25%. On a $300,000 loan over 30 years, that 0.25% costs you about $15,000 extra dollars in interest. Gone. Just like that. Because you waited one day. Now, some lenders charge a fee to lock your rate, and some don't. Ask about this up front. Also ask if they offer what's called a float-down option. This means if rates drop after you lock, you can take the lower rate instead. Not all lenders offer this, but it's worth asking about. According to Yahoo Finance's reporting, you should ask each lender how long their rate locks last, whether extensions are available, and how pricing changes if you need more time to close. Get these answers before you commit. After you lock your rate and submit your application, the lender will order a home appraisal. This is when a licensed professional comes to your house, walks through it, takes measurements, looks at the condition of everything, and then compares your home to similar houses that recently sold in your neighborhood. The appraiser's job is to determine your home's fair market value. And this number is crucial because it directly affects your loan-to-value ratio, which affects your rate and whether you even qualify. If the appraiser says your house is worth $400,000, but you were hoping for $450,000, that could change your entire refinancing plan.
Here's how to prepare for your appraisal. Clean your house. Fix any obvious problems like leaky faucets or broken windows. Make sure all your systems work: heating, cooling, plumbing, electrical. Have a list ready of any upgrades you've made, like a new roof, new floors, a kitchen renovation, or a bathroom remodel. Give this list to the appraiser when they arrive. These improvements add value to your home, and you want to make sure the appraiser knows about them. A little preparation can mean a higher appraisal value, which means better refinancing options for you. After the appraisal, your application goes into underwriting. This is where the lender's team digs deep into your finances. They're verifying everything you told them: your income, your debts, your employment history, your credit, your assets, everything. One important number they look at is your debt-to-income ratio, or DTI. This is the percentage of your monthly income that goes toward paying debts. To calculate it, add up all your monthly debt payments: mortgage, car loan, student loans, credit cards, everything, and divide that by your gross monthly income. Most lenders want your DTI to be 43% or lower, but Fannie Mae's Refi Now and Freddie Mac's Refi Possible programs accept DTI ratios as high as 65% for qualifying borrowers. During underwriting, the lender might come back with questions or ask for more documents. This is totally normal. Don't panic. Just respond quickly. The faster you give them what they need, the faster you get to closing. According to ICE Mortgage Technology, it takes the average borrower about 41 days to close a conventional mortgage as of late 2025. But having your documents ready and responding promptly to questions can shave days off that timeline. Closing day. This is when it all becomes real. You'll sit down, either in person at a title office or sometimes online, and sign a stack of documents. These documents include your new loan agreement, a settlement statement showing all costs, and various legal disclosures. Before you sign anything, read your closing disclosure carefully. This document shows your final loan terms, monthly payment, and all closing costs. Compare it to the loan estimate you received earlier. They should match closely. If you see fees that are significantly higher than what was on your estimate, stop. Ask questions. You have the right to challenge any changes you don't understand or agree with. After you sign everything, there's usually a 3-day right of rescission for refinances. This is important. This means you have 3 business days after closing to change your mind and cancel the whole thing with no penalty. It's like a cooling off period. So if you sign on Monday and then on Tuesday you realize something feels wrong about the deal, you can walk away by Wednesday. The government gives you this protection specifically because refinancing is such a big financial decision. Use those 3 days wisely. Review everything one more time with a clear head. Now, some of you are thinking, I want to refinance, but I don't have $6,000 sitting around for closing costs. Good news! There is an option called a no closing cost refinance.
According to SoFi's 2025 analysis, this allows you to either accept a slightly higher interest rate in exchange for the lender covering your closing costs, or roll those costs into your loan balance. But understand the trade-off. If you take a higher rate, you save money today but pay more over time. Let's say the closing costs are $5,000 and the lender raises your rate by 0.25% to cover them. Over 30 years on a $300,000 loan, that 0.25% cost you about $15,000 in extra interest. So you saved $5,000 upfront but paid $15,000 more over the life of the loan. That's a net loss of $10,000. So when does a no closing cost refinance make sense? When you don't plan to stay in the home very long. If you're going to sell in 3 or 4 years, taking the higher rate might actually be smarter because you won't be paying it long enough for the extra interest to add up past what you would have paid in closing costs. See? It all comes back to the math. And the math changes depending on your situation. So do the calculation. Don't just assume.
Let's go deeper into the cash-out refinance because this is one of the most powerful financial tools available to homeowners. Remember, a cash-out refinance lets you tap into your home's equity and put real cash in your hands. The CFPB published a major report looking at borrowers between 2014 and 2021. They found that the #1 reason people did cash-out refinances was to pay off other bills and debts. Over 50% of borrowers cited this reason. The second most common reason was home repairs and new construction. And here's what's fascinating. The report found that cash-out borrowers actually saw sharp improvements in their credit scores right after refinancing. Why? Because they used the money to pay off high-interest credit card debt. Think about that. You take equity out of your home at, say, 6.5% interest, and you use it to pay off credit cards charging you 24% interest. You go from paying 24% to paying 6.5% on that same debt. Your monthly payments drop, your credit score goes up, your financial stress goes down. It's like a financial reset button. But be careful, because if you keep running up credit card debt after the refinance, you've just added to your mortgage and you still have credit card bills. Use this tool wisely. If you currently have an FHA loan, listen up because this could be the easiest refinancing option in existence. The FHA Streamline Refinance is designed to be fast and simple. According to CNBC's reporting, there is no credit score or equity requirement for an FHA Streamline Refinance. You read that right. No credit score requirement. The only things you need are: your existing loan must be at least 210 days old. You must have made on-time payments. And your new monthly payment must be lower than your current one. That's basically it. No appraisal needed in most cases. Less paperwork. Faster closing. It's called Streamline for a reason. Now, there is a catch. The FHA charges something called Mortgage Insurance Premium, or MIP. This is a fee you pay for the life of your FHA loan. And when you streamline refinance into another FHA loan, you're still paying that MIP. If you want to get rid of that lifetime mortgage insurance, you'd need to refinance into a conventional loan instead. That requires a credit score of at least 620 and usually 20% equity. But if you've built up enough equity and your credit is good, switching from FHA to conventional can save you hundreds of dollars every month. Keep that option in your back pocket. For our veterans and active duty military members, you have a special refinancing option that most people can only dream of. It's called the VA Interest Rate Reduction Refinance Loan, or IRRRL. Yes, they really call it that. Sounds like a sound effect in a comic book, doesn't it? But there's nothing funny about how good this deal is. The VA IRRRL requires no appraisal, no credit underwriting, and can often be done with zero out-of-pocket costs. The main requirement is that you currently have a VA loan, and the refinance must result in a lower interest rate or switch you from an adjustable rate to a fixed rate. That's it. On top of that, VA loans come with no private mortgage insurance requirement, regardless of how much equity you have. This is huge! Most conventional loans charge you PMI if your equity is below 20%.
That can add $100 to $300 to your monthly payment. But with a VA loan, that cost simply does not exist. If you serve this country and you're not taking advantage of VA loan benefits, you are leaving serious money on the table. Talk to a VA-approved lender today, not next week, today. Another government option that many people overlook is the USDA Streamline Assist Refinance. If you bought your home in a rural or suburban area with a USDA loan, this program lets you refinance with minimal hassle. According to CNBC, the USDA Streamline Assist has more flexible credit score requirements with no appraisal or home inspection needed. Your loan must be at least 365 days old, and your payments must have been on time for at least the last 6 months. It's one of the simplest refinancing paths available. The USDA program was designed to help people in rural communities afford homeownership, and this extends to refinancing. If rates have dropped since you got your USDA loan, this program makes it easy to take advantage. The paperwork is minimal, the process is fast, and you can lower your monthly payment without going through a full underwriting process. If you live in a small town or outside a major city and you bought your home with a USDA loan 3 or 4 years ago when rates were much higher, this is practically a no-brainer. Check with your lender. You might be surprised at how much you can save. If you currently have an adjustable rate mortgage, an ARM, I need you to pay very close attention right now. Because switching from an adjustable rate to a fixed rate through refinancing could be one of the smartest financial moves you ever make. Here's why. An ARM starts with a low rate, usually for the first 5 or 7 years. But after that introductory period ends, your rate adjusts based on market conditions. And it can go up, sometimes way up. Imagine your payment jumping from $1,800 to $2,400 in a single month because your rate adjusted from 5% to 7%. That happens. It happens all the time. By refinancing into a fixed-rate mortgage, you lock in your rate for the entire life of the loan. Your payment stays the same every single month for 15 or 30 years. No surprises, no sudden jumps. Just predictable, steady payments you can plan around. The Freddie Mac average for 30-year fixed rates is around 6.11% right now, which is near a 3-year low. If your ARM is about to adjust, or if you're just tired of worrying about when it will adjust, now might be the perfect time to lock in that fixed rate and sleep better at night. One of the most powerful refinancing strategies almost nobody talks about is shortening your loan term. Instead of refinancing from a 30-year loan into another 30-year loan, you refinance into a 15-year loan. Yes, your monthly payment goes up, but the amount of money you save in interest is absolutely staggering. Let me paint this picture for you. Take a $300,000 loan at 6% for 30 years. Your total interest paid over the life of that loan is about $347,000. Now take that same loan at 5.5%, which is close to today's 15-year rates, for just 15 years. Your total interest is about $151,000. You save nearly $200,000 in interest. $200,000! Now the trade-off is real. Your monthly payment on the 15-year loan is higher. Instead of paying about $1,800 a month, you'd be paying about $2,450. That's $650 more per month. Can you afford it? Only you know that. But if you can, the savings are enormous. And you own your home free and clear in half the time. Imagine being completely mortgage-free in 15 years instead of 30. Imagine what you could do with all that money once you have 0 housing payments. That is financial freedom. Now, on the flip side, sometimes life throws curveballs. Maybe you lost your job, or your income dropped because your business had a slow year, or you had unexpected medical bills pile up. Your current monthly payment feels like a weight on your chest. In that situation, refinancing to a longer term can give you breathing room. If you're 10 years into a 30-year mortgage and you refinance into a new 30-year loan, your monthly payment drops because you're spreading the remaining balance over more years. This can free up hundreds of dollars every month for things you need right now,
like keeping the lights on, putting food on the table, or keeping up with other bills.
But, and I need to be honest with you here, extending your term means you pay more interest over time. A lot more. You're also resetting the clock on your mortgage. You had 20 years left, now you have 30 again. So this should be a last resort strategy, not your first choice. Use it when you need it, but go in with your eyes wide open about the true cost. And if your financial situation improves later, you can always refinance again to a shorter term or simply make extra payments to pay down your loan faster. Okay, here's a move that can save you a lot of money that most homeowners completely overlook. If you're paying private mortgage insurance, PMI, refinancing might be your ticket to getting rid of it for good. PMI is something lenders charge you when your down payment was less than 20%. It protects them if you default on your loan, but you pay for it. PMI typically costs between 0.5% and 1% of your loan amount per year. On a $300,000 loan, that's $1,500 to $3,000 a year. That's an extra $125 to $250 tacked on to your monthly payment for protection that doesn't even benefit you. But if your home value has gone up since you bought it, you might now have more than 20% equity. And if you refinance at that new higher value, your loan-to-value ratio drops below 80%, and you can say goodbye to PMI forever. Let's say you bought your home for $300,000 with 10% down, so you borrowed $270,000. But now your home is worth $380,000, and you've paid down your loan to $250,000. Your LTV is now about 66%. That's way below 80%. Refinance, and that PMI payment disappears. That alone could save you over $100 every single month. Now, let's talk about something a little more advanced. What if the property you want to refinance isn't your primary home? What if it's a rental property or an investment property? The rules are different, and you need to know how. For investment properties, lenders charge higher interest rates, typically 1/4 to 0.5% more than they would for your primary home. They also usually require a larger amount of equity, often 25 to 30% instead of the standard 20%. Why? Because lenders see investment properties as riskier. If times get tough, people are more likely to walk away from an investment property than the home they live in. But refinancing a rental property can be incredibly profitable if done right. Imagine you own a rental that brings in $2,000 per month in rent. By refinancing to a lower rate, you drop your mortgage payment by $300. That's $300 more of pure profit every single month. $3,600 a year. Over 10 years, that's $36,000 in extra income without doing a single thing differently. The property is the same. The tenant is the same. The rent is the same. But your cash flow just got a serious upgrade because you were smart enough to refinance. I've been telling you all the reasons to refinance, but let me be fair and tell you when you should absolutely not do it. Because the wrong refinance at the wrong time can actually set you back financially. Do not refinance if your break-even point is longer than the time you plan to stay in the home. Remember that calculation we talked about? If it takes you 4 years to recoup the closing costs, but you're selling in 2 years, don't do it. Do not refinance if the rate difference is tiny. Dropping from 6.4% to 6.2% sounds nice, but after closing costs, you might not save anything at all. Do not refinance if you're already deep into your loan. Here's why. In the early years of your mortgage, most of your payment goes toward interest. But as time goes on, more and more goes toward paying down the actual principal, the amount you borrowed. If you're 20 years into a 30-year mortgage and you refinance into a new 30-year loan, you restart the clock. You go back to paying mostly interest again. That can cost you a fortune even if you get a lower rate. The rejection rate for refinance applications jumped to 25.6% in 2024, which shows that lenders are being careful about who they approve. Make sure refinancing truly benefits you before you apply. Let's talk about something that most refinancing guides skip: taxes. Refinancing has tax implications, and understanding them can help you make a smarter decision. I'm not a tax professional, so always talk to your accountant about your specific situation. But here are the basics you should know. If you do a rate and term refinance, the interest you pay on your new mortgage is still tax deductible, just like your old mortgage, but there's a limit. Under current tax law, you can only deduct interest on up to $750,000 of mortgage debt. For most people, this won't be an issue, but if you have a very large loan, keep this cap in mind. For cash-out refinances, here's the key rule. The interest on the extra money you borrow is only tax-deductible if you use that money to substantially improve your home. So if you pull out $50,000 and use it to add a new bedroom or upgrade your kitchen, that interest is deductible. But if you use that $50,000 to pay off credit cards or buy a car, the interest on that portion is not deductible. Keep records of how you use your cash-out funds. This matters when tax time comes around. The Federal Reserve has noted that federal tax law generally favors mortgage borrowing, and understanding these rules helps you maximize that advantage. Life doesn't always go according to plan. If you've been through a bankruptcy, you might think refinancing is impossible for you. But it's not. It just takes patience and the right strategy. The waiting periods depend on the type of bankruptcy and the type of loan you want. For a conventional loan, you typically need to wait 4 years after a Chapter 7 discharge and 2 years after a Chapter 13 discharge. For FHA loans, the waiting period is 2 years after Chapter 7 and 1 year into a Chapter 13 repayment plan with court approval. During that waiting period, your job is to rebuild your credit. Pay every bill on time, keep your credit utilization low, save as much money as possible, and avoid taking on any new debt that you don't absolutely need. When the waiting period is over and your credit has improved, you can refinance. Many people who went through bankruptcy end up with better financial habits afterward because they learned the hard way what happens when finances get out of control. Your bankruptcy doesn't define you. Your recovery does. And refinancing can be a big part of that recovery story. Another difficult life event that often leads to refinancing is divorce. When a couple splits up, one person usually keeps the house, but the mortgage is still in both names. That means both people are still responsible for the debt, even if only one person is living there. Refinancing is the clean solution. The person keeping the house refinances the mortgage into their name only. This removes the other person from the loan completely. It gives them a clean break financially. No more shared debt. No more worrying about whether the other person will make the payment on time. But here's the challenge. To refinance a loan, you need to qualify based on your income only. If the household previously qualified based on 2 incomes, qualifying on just one can be tough. Your debt-to-income ratio goes up because your income goes down while the mortgage stays the same size. If you're in this situation, talk to a lender early in the divorce process. Find out what you need to qualify on your own. You might need to pay down some debts first, or you might need your divorce settlement to include enough assets to make up the difference. Planning ahead is everything here.
If you earn a lower income, there are special programs designed specifically to help you refinance. Fannie Mae's Refi Now and Freddie Mac's Refi Possible are 2 of the biggest. These programs are for homeowners who make 100% or less of the area median income. What makes these programs special? They accept higher debt-to-income ratios, up to 65% in some cases. They have flexible credit requirements, and they often come with lower fees than standard refinances. The goal is to make refinancing accessible to people who need savings the most. To qualify, your existing mortgage must be owned by Fannie Mae or Freddie Mac, and most mortgages are, even if you didn't know it. You can check by visiting Fannie Mae's or Freddie Mac's website and entering your information. Your mortgage must also be at least 1 year old.
If you qualify, these programs can be a game changer. Lower payments, lower stress, more money in your pocket every month. And you don't need perfect credit or a huge income to get there. These programs exist because everyone deserves the chance to save money on their home. Check your eligibility today. Remember earlier when I promised to show you how to build equity faster? Well, here it is. Building equity faster means you own more of your home sooner, which gives you better refinancing options down the road. There are 3 powerful strategies to do this. Strategy 1. Make bi-weekly payments instead of monthly payments. Instead of paying $1,800 once a month, you pay $900 every 2 weeks. Sounds the same, right? But here's the trick. There are 26 2-week periods in a year, which means you make 13 full payments instead of 12. That one extra payment every year goes straight to your principal, and it can shave years off your mortgage. Strategy 2. Round up your payments. If your mortgage is $1,743, pay $1,800 instead. That extra $57 every month adds up fast over the years. Strategy 3. Make one lump sum extra payment per year. Use your tax refund, a work bonus, or a holiday cash gift and put it straight toward your mortgage principal. Even one extra payment of $2,000 per year can cut your 30-year mortgage down to about 25 years and save you tens of thousands in interest. These strategies work whether or not you refinance, but combining them with a refinance, that's how you build real wealth through homeownership. To truly understand refinancing, you need to understand how your mortgage payments are structured. This is called your amortization schedule, and once you see it, your whole perspective on your mortgage will change. In the early years of your loan, the vast majority of your monthly payment goes toward interest, not toward paying down what you actually owe. On a $300,000 loan at 6%, your first payment of about $1,800 sends roughly $1,500 to interest and only $300 to principal. That means in month 1, only $300 actually reduces your debt. The rest? It goes straight to the bank. But as the years go on, this ratio slowly flips. By year 15, you're paying more toward principal than interest, and by year 25, almost your entire payment goes to principal. This is why refinancing early in your loan makes more sense than refinancing later. When you refinance early, you haven't paid down much principal yet, so restarting the clock doesn't hurt as much. But if you refinance late, you're going back to paying mostly interest again. Understanding your amortization schedule helps you make the right refinancing decision at the right time. Ask your lender for yours, study it, know where you stand. You might hear your lender mention something called discount points, or buying down your rate. This is a powerful tool that most borrowers don't fully understand. So let me break it down simply. A discount point costs 1% of your loan amount and typically lowers your interest rate by about 0.25%. So on a $300,000 loan, 1 point costs $3,000 and might drop your rate from 6.25% to 6%. According to the mortgage reports, a discount point gives you about a 0.25% rate reduction, though this can vary by lender.
Should you buy points? It depends on how long you plan to keep the loan. If that $3,000 point saves you $75 per month, your break-even is 40 months, or about 3.5 years. If you're staying in the home for 10 or more years, buying points is a great deal. If you're selling in 2 years, it's a terrible deal. There's also the opposite of points, called lender credits. The lender gives you a credit toward closing costs in exchange for a slightly higher rate. This is basically the same concept as a no closing cost refinance. The key takeaway is this: points and credits are tools. They're not good or bad on their own. They're good or bad depending on your timeline and your goals. Welcome to the future of refinancing. The process has gone massively digital in recent years. You can now apply for a refinance from your couch at midnight in your pajamas. No suit required.
Online lenders like Rocket Mortgage, Better.com, and SoFi have made the application process fast and straightforward. You enter your information, upload your documents electronically, and get a loan estimate sometimes within minutes. The entire process from application to closing can sometimes be done without ever stepping into an office. But don't sacrifice quality for convenience. Just because an online lender is fast doesn't mean they have the best rates. Always compare online offers with traditional banks and credit unions. Sometimes a local credit union has a rate that beats every online option because they have lower overhead costs. Also, some people prefer having a real person to call when they have questions, and that's something smaller local lenders excel at. The best approach? Get quotes from both online and traditional lenders. Use online tools for speed and convenience, but don't ignore the local options that might offer personalized service and competitive rates you won't find anywhere else. Let me save you from the mistakes that thousands of homeowners make every single year. Mistake number 1, not shopping around. I've said it before and I'll say it again. Getting only one quote is like walking into a car dealership and paying sticker price. You will overpay. Mistake number 2, focusing only on the monthly payment. Some lenders will offer you a low monthly payment by extending your loan to 30 years, but the total interest over the life of that loan could be massive. Look at the total cost, not just the monthly number. Mistake number 3, ignoring closing costs. A rate that's 1/8% lower doesn't help if the closing costs are $3,000 more. Mistake number 4, refinancing too often. Every time you refinance, you pay closing costs. If you refinance every 2 years, those costs add up and eat into your savings. Mistake number 5, taking cash out for things that lose value. Using a cash-out refinance to buy a boat or take a vacation is a bad idea because you're turning short-term fun into 30 years of debt. Use cash-out refinancing for things that increase your wealth, like home improvements that raise your property value or paying off high-interest debt. These 5 mistakes cost homeowners billions of dollars every year. Don't be part of that statistic. One of the most common questions about refinancing is, how long does the whole thing take? The honest answer is, it depends. But I can give you a realistic timeline so you know what to expect. From the day you submit your application to the day you close, the average refinancing process takes between 30 and 45 days. Streamline refinances through FHA, VA, or USDA can be faster, sometimes as quick as 15 to 20 days, because they require less documentation and often no appraisal. Here's a rough breakdown of the timeline. Week 1, you submit your application and documents. Week 2, the lender orders the appraisal and begins underwriting. Week 3, the appraisal is completed and the underwriter reviews everything. Week 4, any conditions are cleared and your closing is scheduled. Week 5, you sign the closing documents and start your 3-day rescission period. After those 3 days, it's done. Your old loan is paid off and your new loan begins. The biggest thing that causes delays is missing documents. If the lender asks for something and you take a week to find it, that pushes everything back. Have your documents ready, respond fast, and the process will be smooth.
Let's address a worry that many people have. Will refinancing hurt my credit score? The short answer is a little bit, temporarily, but in the long run, it usually helps. When you apply for a refinance, the lender does a hard inquiry on your credit report. This can drop your score by about 5 to 10 points. That's normal and temporary. Your score typically bounces back within a few months. And remember, if you shop for rates within a 45-day window, all those inquiries count as one single inquiry. After your refinance closes, your old mortgage account shows as paid off on your credit report and a new account appears. This can cause a temporary dip because the new account has no payment history yet. But as you make on-time payments on your new loan, your score recovers and often ends up higher than before, especially if your new rate means lower monthly obligations that make it easier to pay everything on time.
The CFPB study showed that cash-out refinance borrowers saw credit score improvements because they used the funds to reduce high-interest debt. So don't let fear of a small, temporary dip stop you from making a move that saves you thousands in the long run. There's a term that's been all over the financial news lately, the lock-in effect, and it directly relates to why refinancing matters so much right now. Let me explain what it means. According to ICE Mortgage Technology, at the start of 2025, approximately 39.4 million homeowners had mortgage rates below 5%, including 12.6 million with rates below 3%. These people locked in incredibly low rates during the pandemic era when rates hit historic lows. And now, they feel trapped. They can't move because selling their home means giving up that amazing rate and getting a new mortgage at today's higher rates. By the end of 2025, about 95% of those low-rate borrowers were still holding on to their existing mortgages. 95%! They're staying put even if they want to move, even if their family has outgrown their home, even if they got a job in another city. That's the lock-in effect. But here's what's interesting. If rates continue to drop, more and more of these people will finally feel comfortable refinancing or moving. The Mortgage Bankers Association reported that their refinance index was up 117% compared to a year ago. The ice is starting to thaw, and as it does, more opportunities are opening up for everyone. Here's something brand new that's affecting the refinancing market right now. According to the mortgage reports, the federal government recently moved to purchase $200 billion in mortgage-backed securities. That is a massive investment designed to help push borrowing costs lower. What does that mean for you? When the government buys mortgage-backed securities, it increases the demand for these bonds. Higher demand means prices go up, and when bond prices go up, interest rates go down. It's like the government giving the mortgage market a boost to help make homeownership more affordable. Now, experts caution that the long-term impact of this program is uncertain and probably modest compared to broader market forces. So don't expect rates to suddenly drop to 3% overnight. But this program is contributing to the downward trend we're seeing in mortgage rates right now, and every little bit helps. Even a small rate decrease of 0.25% can save you tens of thousands over the life of your loan. The point is, the environment is shifting in favor of borrowers right now, and smart homeowners are paying attention and acting. Are you one of them? Let's make sure you understand the difference between a rate and term refinance and other types, because choosing the right one matters a lot. A rate and term refinance is the simplest form. You change your interest rate, your loan term, or both. You do not take any extra cash out. This is the cheapest type of refinance in terms of fees and interest rates. Why? Because you're not increasing your debt. You're not borrowing more money. You're simply restructuring what you already owe. Lenders see this as low risk, so they give you better deals. According to Bankrate, cash-out refinances carry higher interest rates than rate and term refinances because when homeowners take cash from their equity, they increase their total loan balance and reduce their safety cushion. So the lender charges more to compensate for that added risk. If your only goal is to lower your rate or change your term, stick with a rate and term refinance. Don't take cash out just because you can. Every dollar you borrow against your home is a dollar you have to pay back, plus interest. Keep it simple, keep it focused. Get the best deal on what you need and nothing more. Everyone wants to know, where are interest rates going? If I could predict that with 100% accuracy, I'd be on my own private island right now instead of making this video. But here's what the experts are saying. The Federal Reserve kept rates unchanged at its January 2026 meeting, holding the benchmark rate at a target range of 3.5 to 3.75%. The Fed delivered 3 quarter-point rate cuts in late 2025, and Bankrate experts expect further cuts in 2026, which could eventually push mortgage rates lower. But here's the reality. Nobody can perfectly predict the future. Inflation, employment data, global events, and political decisions all affect where rates go. The smartest approach is not to try to time the market. Don't wait for the perfect rate. If refinancing makes financial sense for you right now, based on your break-even calculation and your personal situation, then do it now. Because here's what people forget. Every month you wait is a month of savings you're missing out on. If refinancing saves you $200 a month and you wait 6 months hoping for a slightly better rate, you just lost $1,200 in savings, and there's no guarantee rates will actually drop. Want to get the highest possible appraisal value when you refinance? Of course you do. Here are some simple improvements that can boost your home's value without breaking the bank. First, curb appeal. A fresh coat of paint on the front door, trimmed bushes, a clean walkway, and some flowers by the entrance can make a huge first impression. Appraisers are human. They're influenced by how a home feels, not just the square footage. Second, deep clean everything. A sparkling clean house looks like a well-maintained house, and well-maintained houses get higher appraisals. Third, fix small things that signal neglect. Dripping faucets, cracked tiles, peeling paint, squeaky doors. These tiny issues make an appraiser think, what else is wrong that I can't see? Fix them all before the appraisal. Fourth, update your kitchen and bathroom if you can. These are the 2 rooms that affect home value the most. You don't need a full renovation. Even swapping out old cabinet hardware, adding a new faucet, or installing a modern light fixture can make the space feel fresh and updated. And fifth, prepare a list of all improvements you've made since buying the home. New roof? New water heater? Added insulation? Give this list to the appraiser. They need to know about these upgrades to give you an accurate value. Most people don't know this, but many refinancing costs are negotiable. Yes, you can negotiate with your lender, and doing so can save you hundreds or even thousands of dollars. Start with the loan origination fee. This is usually 1% of your loan amount, and it's often the largest single fee you'll pay. Ask your lender if they can reduce it. Tell them something like, I've received a loan estimate from another lender with a lower origination fee. Can you match it or beat it? Many lenders would rather lower their fee than lose your business entirely. Next, ask about waiving the application fee and the credit check fee, especially if you're an existing customer. Some lenders waive these for repeat borrowers as a loyalty incentive. According to Fortune, your existing lender might offer incentives such as waiving closing costs if you stay with them. So always talk to your current lender first before going elsewhere. You might be surprised at what they'll offer to keep you. And finally, don't be afraid to walk away. The best negotiating position is being willing to take your business somewhere else. When a lender knows you have other options, they work harder to earn yours.
Let's dig deeper into 2 programs that could save you a lot of money. Fannie Mae's Refi Now and Freddie Mac's Refi Possible. These programs are specifically designed for homeowners with lower incomes who want to refinance but might not qualify through traditional channels. To qualify for Refi Now, your income must be at or below 100% of your area's median income. The program reduces fees and offers competitive rates to make refinancing affordable. Your existing mortgage must be owned by Fannie Mae and be at least 12 months old. Similar rules apply for Freddie Mac's Refi Possible program. Here's the best part about these programs. They accept debt-to-income ratios up to 65%. That is much higher than the standard 43% limit most conventional refinances require. This opens the door for people who have higher monthly debts relative to their income. Maybe you're paying student loans, a car payment, and a mortgage on a teacher's salary or a nurse's salary. These programs understand that and work with you instead of shutting you out. Check if your loan is owned by Fannie Mae at fanniemae.com or by Freddie Mac at freddiemac.com. It takes about 2 minutes. And those 2 minutes could lead to hundreds of dollars in monthly savings. Let me talk about something no other refinancing guide will tell you. The process can be stressful, and that's okay. It's a big financial decision. You're dealing with lots of numbers, lots of paperwork, and the pressure of making the right choice. Some people lose sleep over it, wondering if they're getting the best rate, worrying about the appraisal, or stressing about whether they'll even get approved.
That anxiety is normal. You're not alone in feeling it. But here's what I want you to remember. You're not making this decision forever. If you refinance and rates drop even more next year, you can refinance again. This is not a one-time permanent choice. The most important thing is to make a decision based on math, not emotion. Do the break-even calculation. Compare your offers. Read the fine print, and then trust the numbers. Don't let fear of making the wrong choice paralyze you into making no choice, because doing nothing when refinancing could save you hundreds per month. That is the wrong choice. Take a deep breath, follow the steps in this course, and trust that by the end of this video, you'll have everything you need to make a confident, informed decision. Should you use a mortgage broker or go directly to a lender? This is a question many homeowners wrestle with, and the answer depends on your situation. Let me explain the difference. A direct lender, like a bank or credit union, offers you their own loan products. They have their rates, their terms, their fees. What you see is what you get. A mortgage broker, on the other hand, doesn't lend money directly. Instead, they shop your application across multiple lenders and find the best deal for you. Think of them as a personal shopper for mortgages. The advantage of a broker is variety. They might have access to lenders and programs you'd never find on your own. They can be especially helpful if you have an unusual situation, like being self-employed, having a complicated income structure, or working as a freelancer with income from multiple clients. The downside? Brokers charge a fee, usually paid by the lender or rolled into your closing costs. This could mean a slightly higher rate than going direct. The best approach? Get quotes from both, a broker and direct lenders. Compare everything, then choose whoever gives you the best total deal. Don't be loyal to one method. Be loyal to your wallet. If you own a multifamily property, a duplex, triplex, or fourplex, refinancing can be even more beneficial than for a single-family home. Here's why. With a multifamily property, you can use the rental income from other units to help you qualify for the refinance. If you live in one unit of a fourplex and rent out the other 3 units for $2,000 each, that's $6,000 in monthly rental income that lenders can count toward your qualification. This makes it much easier to meet the debt-to-income requirement.
But there are some differences you should know. Interest rates on multifamily properties are typically slightly higher than single-family rates. Lenders usually require more equity, often 25 to 30%, and the appraisal process is more complex because the appraiser needs to evaluate the property as both a home and a business. Despite these extra hurdles, refinancing a multifamily property can dramatically improve your cash flow. Imagine cutting your mortgage payment by $400 per month on a fourplex that already generates $6,000 in rent. That's $400 more of profit every month without raising anyone's rent or doing any extra work. Smart investors refinance their multifamily properties strategically to maximize returns. What happens if you get denied for a refinance? First, don't panic. A denial is not the end of the road. It's a speed bump, not a dead end. And understanding why you were denied is the first step toward getting approved next time. The most common reasons for denial are low credit score, high debt-to-income ratio, not enough equity in the home, unstable employment history, or problems with the appraisal. Your lender is required by law to tell you why you were denied, so read that denial letter carefully. It's your roadmap for what to fix. If it's a credit issue, work on your score for 3 to 6 months and try again. If it's a DTI issue, pay down some debts or increase your income first. If it's an equity issue, you might need to wait for your home value to increase or pay down more of your principal. And if the appraisal came in low, you can try a different lender who might use a different appraiser or make some home improvements to boost the value. The point is, a denial today doesn't mean a denial forever. Many successful refinances happened on the second or even third attempt. Keep working toward your goal. The savings are worth the effort. If you have a second mortgage or a home equity loan on top of your primary mortgage, refinancing gets a little more complicated, but it's definitely still possible. Here's how it works. When you refinance your first mortgage, your second mortgage lender needs to agree to stay in second position. This is called a subordination agreement. Without it, your second mortgage would technically become the first lien, and no new lender will agree to that arrangement. Getting a subordination agreement can take extra time and might involve fees. Some second mortgage lenders are cooperative and others
not so much. If your second lender won't subordinate, you have a few options. You can refinance both loans into a single new mortgage, essentially consolidating your debts. This can actually be a great move if your second mortgage has a high interest rate, because you'd be rolling it into a lower rate first mortgage. Or, you can pay off the second mortgage before refinancing the first. If you have the cash to do this, it simplifies everything. Talk to your lender about your specific situation. They deal with subordination agreements regularly and can guide you through the process. Timing can make a real difference in your refinancing outcome. While I said earlier that trying to perfectly time the market is usually a losing game, there are some timing strategies that make sense. First, watch the Fed meeting calendar. The Federal Reserve meets about 8 times per year, and their decisions directly influence mortgage rates. Rates often drop right before an expected rate cut as markets price in the change. The Fed's next meeting is scheduled for March 2026, and analysts are watching closely for signals of further cuts. Second, consider the time of year. Mortgage lenders tend to be busier in spring and summer when more people buy homes. During the slower fall and winter months, lenders are often more hungry for business and might offer better deals or faster processing to keep their teams busy. Third, pay attention to your personal readiness. Is your credit score at its highest? Have you paid down your debts? Have you gathered all your documents? The best time to refinance is when the market conditions are good and your personal finances are strong. When both of those align, that's your moment. Seize it. All right, let's bring it all together with a complete refinancing checklist. This is your step-by-step action plan. Save this, screenshot it, print it out, and put it on your refrigerator. This is your roadmap to a successful refinance.
Step 1. Check your credit score and fix any errors. Step 2. Calculate your home equity and know your property value. Step 3. Determine your refinancing goal. Is it a lower rate, lower payment, cash out, or term change? Step 4. Calculate your break-even point to make sure refinancing makes financial sense. Step 5. Gather all required documents and put them in one folder. Step 6. Shop at least 3 lenders, including your current one. Step 7. Compare loan estimates by looking at APR, total closing costs, and monthly payments. Step 8. Choose your lender and lock your rate. Step 9. Complete the appraisal and underwriting process by responding quickly to any requests. Step 10. Review your closing disclosure, sign the documents, and use your 3-day rescission period wisely. That's it! 10 steps. Follow them in order, and you will have a smooth, successful refinance that saves you real money. Let me show you some real math so you can see exactly how much refinancing could save you. The example from Yahoo Finance shows a homeowner who took out a $500,000 30-year fixed mortgage at 7% in 2022. Their monthly payment was $3,327. If rates drop to 5.75% and they refinance after 48 months, their new payment drops to $2,786. That's a savings of $541 per month. $541. That's $6,492 every year going back into their pocket. Over the remaining life of the loan, those savings add up to staggering numbers. Even on a more modest example, say you have a $300,000 mortgage at 7% and refinance to 6.1%. You'd save about $180 per month. That's $2,160 per year. Over 10 years, that's $21,600. That is real money that changes real lives. A family vacation every year, a fully funded emergency savings account, college tuition for your kids. Refinancing isn't some boring financial exercise. It's a path to the life you want. I need to warn you about something important. Not every lender has your best interests at heart. There are predatory lenders out there who will try to take advantage of you, especially if you're unfamiliar with the refinancing process. Red flags to watch for. Any lender who pressures you to act immediately and won't give you time to think. Any lender who promises rates that seem too good to be true. Any lender who discourages you from shopping around or comparing offers. Any lender who tries to pack your loan with unnecessary fees or products.
and any lender who suggests you lie about your income or inflate your home's value on the application. If you see any of these red flags, walk away immediately. Legitimate lenders will never pressure you. They'll give you a clear loan estimate. They'll encourage you to compare offers, and they'll answer all your questions patiently. Here's a pro tip. Check your lender's license through the Nationwide Multi-State Licensing System, or NMLS. Every legitimate mortgage lender is registered there. If they're not, that's all you need to know. Also, look up reviews. Check the Better Business Bureau. Talk to friends and family who've refinanced recently. Protect yourself by doing your homework before you sign anything. Congratulations! You've refinanced your home. The hard work is done. But there are a few things you need to do after closing to make sure everything goes smoothly. First, set up automatic payments on your new loan. This prevents any chance of accidentally missing a payment during the transition from your old loan to your new one. There's usually a gap of 1 to 2 months between your last old payment and your first new payment. Some people mistakenly think this is a free month. It's not. Interest is still accruing. Your first payment on the new loan will include that accrued interest.
Second, keep all your closing documents in a safe place. You'll need them for tax purposes, including the settlement statement that shows how much you paid in points and closing costs. Some of those costs may be tax deductible. Third, monitor your old loan account to make sure it shows as paid in full. If it doesn't reflect correctly within 60 days, contact your old lender immediately. And fourth, if you have extra money now thanks to your lower payment, put it to work. Either invest it, save it for emergencies, pay down other debts, or add it to your new mortgage payment to pay off your home even faster. Don't just spend it. Make it count. Let me quickly answer the questions I hear most often about refinancing. Can I refinance if I'm underwater on my mortgage? Meaning you owe more than your home is worth. It's difficult, but some programs exist. Check if your loan qualifies for Fannie Mae or Freddie Mac assistance programs. How many times can I refinance? There's no legal limit. You can refinance as many times as you want, but each time comes with closing costs, so make sure the math works each time. Will my escrow account transfer? Usually yes, but there can be a transition period where you need to prepay some taxes and insurance into a new escrow account. Your old escrow balance should be refunded to you within 30 days after closing. Can I refinance with a cosigner? Yes. Adding a cosigner with good credit and income can help you qualify if you wouldn't qualify on your own. But remember, they're equally responsible for the debt. Do I need to live in the house to refinance? For a primary residence refinance, yes, but there are specific refinancing options for investment properties and second homes. Each has different requirements and rates. These are all great questions, and asking them means you're thinking critically about your decision. Keep asking questions. Knowledge is your power in this process. Listen, I've given you a lot of information in this course. Statistics, strategies, step-by-step instructions. But none of it matters unless you take action. Knowledge without action is just entertainment. And I didn't make this video to entertain you. I made it to change your financial life. ICE Mortgage Technologies data shows that nearly 1.3 million mortgages carry rates between 6.875% and 6.99%, making them the most sensitive group to recent rate declines. If you're in that group, the window is open right now. And even if your rate is higher, 7%, 7.5%, or more, the savings potential is even greater. Stop thinking about it and start doing it. Tonight, check your credit score. This week, gather your documents. This weekend, start getting quotes from lenders. By next month, you could be signing closing papers on a refinance that saves you hundreds of dollars every month for years to come. That's not just money. That's freedom. That's less stress. That's more options. That's a better life. And it starts with one simple decision: to stop watching and start acting. You have everything you need.
Now go do it. Thank you for staying with me through this entire course. I mean that. The fact that you watched this far tells me you're serious about improving your financial situation, and that puts you ahead of most people already. Let me leave you with one final thought. Your home is probably the biggest investment you'll ever make, and refinancing is one of the most powerful tools you have to make that investment work harder for you. Freddie Mac's data confirms that rates right now are at their lowest in over 3 years. That is not something to ignore. That is something to act on. Bookmark this video. Share it with someone you love who owns a home. Come back to it when you need a refresher on any step. And most importantly, go start your refinancing journey today. Not tomorrow, not next month, today. Because the best financial decision is the one you actually make. I'm rooting for you. Now go get that better rate and save yourself some real money. I'll see you in the next one.